Well, we made a low in 2015, December, just above 1,050 gold. We've now doubled that and a little bit more, 2,500. So we're nowhere near the metrics of the prior bull markets in terms of what is the multiple gain over the span of, let's say, a decade. We're nowhere near close. If we matched those, merely matched the geometrics of those moves, would be $8,000 gold. While we're going a lot higher over the next year, let's say. I mean, a lot, maybe even 8,000 gold. I think silver could be a couple $100 an ounce.
Gold made a low in December 2015 at just above $1,050 and has since more than doubled to $2,500, but it's still far from the gains seen in past bull markets. If gold matches the geometric multiples of previous decades-long runs, it could potentially reach $8,000, with silver climbing to a couple of $100 an ounce over the next year. Recent news shows the price of gold is approximately $2,513.30 per ounce, showing a slight increase of 0.39%. Meanwhile, silver is trading at around $29.45 per ounce, which represents a minor rise of 0.11%. Michael Oliver is a prominent financial analyst and market strategist. Gold and silver have recently broken out of their momentum ceilings, leading to significant price increases. Gold surged past $2,000, reaching up to $2,500, while silver rose from around $20 to nearly $30. Meanwhile, the U.S. bond market has broken above a key momentum ceiling, with T-bond futures climbing from just above 120 to the 124 and 125 range, indicating a shift toward perceived lower-risk assets like bonds over higher-risk ones like stocks. The dollar index, which has been mostly stagnant since early 2023, recently broke below a critical support level, now trading under 101 and nearing the 100 mark, signaling potential weakness. This aligns with the broader trend of shifting asset classes, with investors favoring gold and bonds while moving away from stocks and the dollar. The Nasdaq 100's momentum floor is the last key level to watch. A break would confirm this broader shift toward long positions in gold and bonds and short positions in stocks and the dollar. The bond market is now moving inversely to the stock market, aligning with the expected shift in asset allocation. Michael Oliver, in an interview with Kai Hoffman, tells the traditional 60-40 portfolio mix of 60% stocks and 40% bonds was a disaster in 2022, as both asset classes suffered significant losses, with bonds faring worse than stocks. However, current technical indicators suggest a return to the historical norm, where the long end of the debt market, particularly T-bonds, is seen as a safer investment relative to stocks. Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
Gold and silver and the miners broke out above annual momentum basing actions as of March of this year. In other words, I had momentum structure overhead, like the floor I described on the S&P below that you're likely to break, momentum floor I'm talking about. Gold had a ceiling above it, and it broke through it, and that's when gold gushed above 2,000 and shot up now to 2,500. Silver went from, $20 to 32, it's now just below 30. That occurred then, but when I looked at the other major asset categories, like the bond market, US T-bond market, dollar index, the dollar index was holding a floor on its quarterly momentum that we defined as being broken at 104.40 about a month ago. This is cash dollar index. It's now down under 101. It's 100.50, I think. So it's dropped, not crashed. It's just oozed down fairly significantly. And I know if you break 100, you're going to have a lot of price chart technicians start to scratch their head and say, oh my gosh, this is topped out. We think it's topped out. So we've had the bond market was doing the opposite. The bond market, if we plotted our momentum oscillator, quarterly momentum again, where you plot monthly action in relation to a 3-quarter moving average, it was confined below a ceiling. In other words, a shallow ceiling, not a floor to break, but a ceiling to break out above. You broke out above that a month ago. T-bond futures then were just above 120. Right now we've been up to 126. We're trading 124, 125 area. So they broke out of a quarterly momentum base to the upside, lagged to the gold breakout that it registered in March. So again, we have two big asset categories that broke out upside based on our long-term momentum. And we thought the bonds should do that. Why? Not because the Fed's cutting rates. We're talking long into the debt market here. It's because asset managers begin to reallocate assets out of that which they perceive to be higher risk, less reward, into something lower risk, more reward. And that would be the T-bond market. Whereas a lot of them perceive the stock market to be less reward, higher risk potential. Now, they have to be long because they're competing with other asset managers. And if you're not long and it's going up, you lose customers. But there's a lot of suspicious asset managers out there who are ready to make that shift. And they've already begun to. You can see it both in the T-bond upside action. You can see it in the stall in the stock market. And you can see it in the gold surge that we've had since late March. So there's been some asset class shift out of those three categories. The dollar foreign exchange, major foreign exchange, again, the dollar is inverse of primarily the euro and the yen. That comprises about 70% of it, of the dollar index. It has been dead as a doornail for almost 2 years, where after that collapse we had in 2022, we were up at $115 index. We collapsed down near 100. And since then, since early 2023, the dollar has more or less gone sideways in about a single percentage range, up, down, but going nowhere. So it was a non-event. It was the quiet one, we called it. Watch out for the quiet one, sitting in the corner. Okay. It broke its quarterly momentum to the downside. Again, so another major asset category that where quarterly momentum is looked at as our trend assessment, it is now freshly broken to the downside. So again, gold upside, March. A couple of months later, bonds upside. And over the last month, dollar downside. The only one that's waiting is, again, what I described with the NASDAQ 100, the floor underneath quarterly momentum on the stock market. That's the last one to complete, and I think it will, meaning break to the downside. That means all those four major asset categories will have decided their new direction. In this case, we're talking long gold, long T-bonds, short stocks, short dollar. That's how we see that. And I think you've seen it in the T-bonds as well. They're now moving inverse to the stock market, which is something we expected to see happen. Where I think you're getting that 60-40 portfolio mix, the orthodox thing, 60% stocks, 40% bonds. That was a disastrous concept in 2022. They both got smashed, huge. Bonds were down more than stocks that year. But this time the technicals justify that relationship back to normal, where bonds, long into the debt market, is a safe place to be relative to the stock market.
Michael Oliver explains that gold experienced major bull markets in the past, including the mid-1970s to 1980, when it rose from a fixed price in the $30s to $850, and from 2000 to 2011, when it surged from $260 to around $1,920. In both cases, gold saw eightfold increases over roughly a decade. A surge in gold and silver prices is expected in the next month or two, potentially shocking markets with its speed. While it may not push gold to $8,000 or silver to $200, silver could quickly break through resistance at $32, triggering a rally beyond $50. If silver moves rapidly past these highs, it could reach $55 or more, surprising traders with the pace of the ascent. Investors in leveraged positions like call options or futures may want to consider shifting into unleveraged holdings, such as bullion equivalents, during this surge. Gold and the stock market, S&P and NASDAQ, are showing opposite trends when looking at their monthly momentum. While gold's price has pulled back since its peak in April, with momentum declining despite some price stability, stock market momentum has been rising for nearly a year. Although day-to-day actions may seem in sync, monthly momentum charts reveal an inverse relationship. This could lead to a surprising scenario where stocks roll over, generating fear, while gold doesn't follow, potentially triggering a buying panic in gold. The apparent synchronization is misleading. They're actually out of sync. The U.S. Banks ETF crashed in March, dropping over 30% within weeks, a sharp decline that significantly outpaced the broader market's 5 to 10% drop. This banking sector crash caught investors and the Fed off guard. But gold and silver rose during this period, reflecting their safe haven appeal amid financial instability. Let's back to the interview.
Gold was in the fixed price in the 30s and went to 850, 1980. And then from 2000 to 2011, 10, 11-year bull market went from $260 to $1,920. You had 8-fold moves, 8+ fold moves over the span of a decade, let's say. But I think there's about to be a surge in the next month or two that could be breathtaking in itself. No, not get us to 8,000 gold, not get us to 200 silver, but get you somewhere so fast that people are yanked into a new sense of reality. Where silver, for example, suddenly blows through its dual highs. It now made it $32. You went to 32, backed off to 29, back to 32, then you went to 26.50. Then you're back up to 30 recently, uptick it. You get back to 32 a third time, and I'll bet you're going to break out and hit 33, in which case your price chart guys are going to say, my gosh, all my skepticism, I gotta forget it. We're going up. I think you could get a white knuckle flight going through those recent highs that takes you well beyond the 50 level. Now, I'm not saying to go to 100, 200, no particular thing. I think there's a time frame here that's probably more important. And I think that if you do start to engage more to the upside, gold's already done quite a good job, but silver, for example, getting back up to close to 32, let's say, then we're about to engage over the next month or two after that, meaning September, October, into some levels that may shock people, especially in the speed at which you get there, such as taking out the old dual highs at 50, for example, going to 55, let's say. I could see that kind of move occurring quickly. But then from a trading point of view, especially if you're in call options that have expiration dates and you're leveraged futures, let's say, if we get such a surge, it's time to maybe think about, we're focused on this, think about maybe shifting out of leverage into perhaps bullion equivalents, unleveraged position. But we oscillate price in relationship to where's the 3-month average this month? Where is gold price in relation to that? Is it above it, below it? And if we plot it on our oscillator, if you go back a year and plot a monthly momentum of the S&P or NASDAQ, and go back a year and plot a monthly momentum bar chart of gold, they're in total opposite sync. The stock market is trying to top its monthly momentum. Gold has been pulling back since an April peak reading high. And we know we got the 2450 back in April. Now, price has gone marginally higher, but momentum has corrected downside. While price cooled off, momentum had a benign pullback. But the momentum readings dropped while the S&P readings were going up. Ever since almost a full year ago, you could put these charts on a page and you'll see they're total opposites. So yes, the day-to-day action sometimes tells you, oh, they're in sync. But when you look at monthly momentum, they're totally inverse. And we're more focused on that. So I think a lot of people are going to be fooled when the stock market rolls over and generates some fear that if gold doesn't go with it, you're going to have a lot of people fooled and therefore surprised. And what does surprise create? Sometimes panic. In this case, buying panic. In case of stocks, in case of the gold market. So anyway, so don't have that in your mind too much, the synchronization, because they're really out of sync. The KBE, the ETF of the U.S. banks, crashed starting in March, so about 6 weeks after we put out that report. It hit our trigger number, and it actually dropped 30+% in a matter of several weeks. So we did have a crash event in the stock market, in banks. And the stock market reflected it to some extent. It only dropped 5 or 10%, the S&P, whereas the banks dropped a full crash mode, 30+% rapidly. Gold went up during that time. So did silver. So you actually had a bank ambush. It surprised people. It surprised the Fed, surprised investors. It didn't surprise gold, and gold went up during that time.
Recent market trends show a shift towards gold and bonds as preferred safe havens amid financial uncertainty. As momentum builds in gold and silver, their potential for gains stands out against the volatility in stocks and the dollar, emphasizing the need for strategic asset allocation during market turmoil. What factors could drive gold and silver prices to surge rapidly in the next month or two, and how should investors adjust their positions? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.